Thank you all for attending today's webinar. We're excited to present it to everybody today. And as Samantha and Steve mentioned, the topic is reviewing personal tax returns and what you need to know. So, in discussing that, we're going to get into the mechanics of the tax return, what you need to know, what does it mean when you have the tax return in your hands? What should you be looking at? What are the key factors? We're really not going to go into any type of tax law or tax provisions or tax regulations. But as Steve pointed out, we do have webinars on that. So if you wanted to look that up on our website, you certainly could do that. And in today's presentation, we're going to be going through the 1040 for the tax year 2024. And we will show you 2025 return and what the differences look like, but we don't have any filled out 25 returns since the tax season just ended, and most of the meatier tax returns are probably on extension, due to waiting on other information or other closings on businesses they may have. So we'll be looking at information on the 24 tax return. So again, I'll just read the list. You can see the meaningful section of the personal tax return. And this is on pages 1 and 2. The filing status, the question about digital assets, personal information, the income sections, adjustments to income, deductions, tax credits, payments we'll get into, and refund and amounts overpaid. And obviously there's a signature section. So with that, Lou, I guess we can just start going through the key information on the tax return. Can you make that larger or?
Absolutely.
Perfect. Okay. So what this accompanies the tax return that goes to the party, all parties. This, when you file returns, obviously for the past number of years, they're electronically filed. And what the 8879 is authorization from the parties that allows the preparer to sign their name electronically, and files the return electronically with the IRS, and this stays with the taxpayer. This gives me a little confidence that the return I'm looking at was the one that was actually filed, or that the return was filed. There's really limited information here, but I would just want to point out on line 4, amount you want refunded to you. And that's exactly what that line means. Amount you want refunded to you. And in this particular case, it's $17,000. Now, that doesn't mean that this is what the client overpaid. The client could have overpaid $200,000 and only requested $17,000 refunded, and the rest applied to the following year, which we will get into. So I guess we could go right. Yeah, right. So this is page 1 of the 1040. And I want to point out 2 important sections. Section that I'll be talking about now is a personal section, and then I'll get into the income section. So when you're looking at a return, you want to know what year you're looking at. 2024, that's the return we're looking at. It is a 1040, and it has personal information there. What I look at first, well, one of the things I do look at is what town do they live in. I like to know the town and the state that the parties live in. I also want to go down to the filing status. How are they filing? Am I looking at a single taxpayer's return? Am I looking at a married filing joint return, married filing separately, or head of household? Filing single, married filing separately, head of household, it's one income for that party on that return. Married filing jointly could have both parties' income on there if both spouses are working. The next item you want to look that is on the return, and I think it's been on, and Luca clarify if it was 2020 or 2021. The question about 2020. Okay, great. So is digital assets. You see it says digital assets, and you see a box yes or no. The box is checked no. That doesn't mean they don't have digital assets. What you need to do is read that it states that anytime during 24, did you receive, did you get as a reward for property, for property or services? Did you exchange or otherwise dispose of digital assets? They want to know if you had any activity. That doesn't ask if you own digital assets or not. So if you see the box checked no, you cannot assume that they do not have digital assets.
And just one more thing to add to that. It not only speaks to the activity of digital assets in that particular tax year, uh, it actually doesn't speak to any purchases of digital assets. So you could conceivably have a taxpayer who has purchased Bitcoin or purchased NFTs, and that would not qualify for checking off the box yes here. It's strictly the nomenclature receive. And there are a lot of people out there that are receiving compensation in the form of cryptocurrency now. There's actually an NFL player who's getting paid in Bitcoin. So that person would have to check off the yes because they're receiving digital assets for services. Back to you, Rich.
Thanks, Lou. The next section in the personal section are dependents. You know, what is the makeup of the family and how many dependents are they claiming? And that's basically what I look at in this section. The next section is the income section. And the income is from line 1A right through line 9. So if you go down to line 9,
Yep.
I believe it's line 9, total income. The total income for this taxpayer was $275,000. That is exactly where I go. When I pick up a tax return and I see that I want to know the filing status, I'd like to know the dependents, where they live, and does this total income support what I just saw? If it's married filing jointly, you have two adults, three dependents, that's five individuals. They live somewhere on Long Island or somewhere in New York, and I see on line um, uh, 9 that it's $275,000, or if I see it's $100,000, I'm going to question it. How's a family of five living on $100,000? So the total income is a key area to look at. Also, in the matrimonial world, we like to look at this statement of net worth, and we add up their expenses to see if they're meeting a lifestyle. Does the tax return support their lifestyle? There's also adjustments that is made to the total income. So total income we like to look at. Then for tax purposes, there's adjustments to this income to get to what's called adjusted gross income. Adjusted gross income is utilized for IRS purposes, and the taxpayer for phase out provisions and exclusions. The higher your AGI is, the less deductions and credits that you're entitled to. For example, the adjusted gross income here is 273,000. And if you all know on your Schedule A itemized deductions, you can deduct 7.5% over your AGI for medical expenses. So if you multiply 7.5% on a $273,000, you get about $20,000. So if their medical expenses were $20,010, they get a $10 deduction. If it was $100,000, they get a $7,500 deduction. So the adjusted gross income is utilized through a lot of deductions and credits, etc. So, Lou, could you just go to line Schedule 1?
Yes.
So
Rich,
when you have total
Rich, wow,
income,
sorry to interrupt. I figured while you were going over to Schedule 1, someone in the chat asked, why is their town of residence relevant?
oh, the town of residence is relevant for me because I'd like to know where the people live. If somebody is living, let's say, in a high income area and they have low income on a return, then there may be underreported income. So I like to try and match the income to the where the town that the individuals live in.
And
So for me, it's an indicator.
And I would also add to that, there are times when we're doing income analyses, and if we're going to factor in taxes, if you know the town and state that they live in, you'll understand what level of local taxes they're subject to. So someone on Long Island would be subject to New York State taxes, but if we have someone who's living in Queens or Brooklyn or Manhattan, they would obviously also be subject to the New York City taxes. So it helps with that as well.
Hmm. Yeah. So if you go to page two on this one, but this is page one. So page two, if you can go to the top, Lou. So these are the adjustments to income that I was talking about. From total income to get to adjusted gross income. These are the adjustments that you can take or um, deduct, which is and I just highlighted some the education expenses, self-employment tax, simple qualified plans, alimony paid, and your IRA deduction. And when you get to the bottom of that, that's what gets carried over to the other deductions to get you to adjusted gross income.
Okay, we'll go back here,
Yeah, the figure of the face of the return, right?
right here.
Yeah. So now we have adjusted gross income. And from adjusted gross income, we take what's called a standard deduction or itemized deductions, which Sue will be talking about in a minute. And that's what gets you to taxable income. So we have your total income, key indicator that you want to look at. Adjusted gross income is phase outs that the IRS uses or pinpoints. And then we come down to taxable income. Uh, the next page, Lou.
Okay.
Rich, in the meantime, we have another question, and I think this is a more complicated question than it seems on its face. Is there a way to determine what each spouse makes on a joint return?
Yeah. Well, yes. One, yes. And two, it depends on the preparer. Because you can say if it's the taxpayer's income on interest and dividends, and you can say if it's the spouse's uh, income and dividends on a tax return. And for wages, they usually do break that out. So I say yes, but it's dependent on the preparer. And obviously, you can always get backup data, and that will tell you just by the Social Security number. So
Yeah,
I
and I
hope that
think
answered that question.
and a little bit of a longer answer is also when you look at the tax return on its surface, there isn't going to be one nice, neat schedule that says here is spouse A's income and here's
Right.
spouse B's income. You do have to go schedule by schedule. And like Rich said, the income is generally tied to a social security number. You could parse it out that way as you go through the tax return, but there isn't, form, 1, 2, 3, 4 that specifically lays it out for you like that.
Right.
Thanks, guys.
So we just went through the personal section. We just went through the income section. Now on page two is the tax section. What is the tax liability? So here where it says tax and credits on line 16, that's the tax that is on their income. And there's additional taxes that come from other types of income that they had. But on line 24, that's their total tax. So at the end of the day, their total tax was $60,000. Next, we look at the payments. What payments did they make during the year? And some people can, say this could be the refund engine. Is this with the refund engine is what was the withholding on the W-2s, other withholdings from possible 1099s, and then line 26, which they don't have here, is any estimated tax payments that they may have made. So you can tell on line 33 the total payments. So the taxpayer had total payments of $78,000. Their total tax was $60,000, which means on line 34, they overpaid their taxes by $17,000. Now, if it was reversed and their tax liability was 78,000 and they withheld 60,000, you would see on line 37 amount that they owe. But let's look at line 34, right? That's the amount they would owe if it was reversed. Now you look at line 34, $17,643, and that's what they elected to have refunded to them, right? It says line 35A, refunded to you. So they had 100% of it refunded to them. On high net worth clients or high net worth individuals that have passed through income that could be on estimated taxes, it's not uncommon to see on line 34 that they overpaid their taxes by $200,000. And it's not uncommon to see refunded to you zero because they wanted it applied to the next year. So they have a $200,000 credit with the IRS. It's very common. However, in the following year, if a divorce ensues, who has entitlement to that $200,000? And it's the party who files first. Now, there's nothing wrong with that, but you need to sit with your clients and discuss if there's an overpayment. At the end of the day, how is that going to get trued up, so to speak? So you do need to look at overpayments, and if there was any overpayments applied to a following year, in the year of divorce.
Rich, when you say that will be attributed to the party that files first, do you mean the one who files first in the next year,
Yeah.
from a time perspective, or the person who the taxpayer is on the top line of the tax return?
No, it's the taxpayer that files first because it's a joint tax return. So if the taxpayer files first, that you say in line one, they'll get it. If it's line two, they would get it. And then we have we went over the signature part. So
Rich,
that's basically two on the 1040.
so sorry to interrupt. We just want a piece of clarification. So someone in the chat said they thought it was the first Social Security number on the return that it will be attributable to.
I don't recall that. I mean, I could certainly get that information, to confirm that.
We will answer that after the fact. Thank you.
And then I believe we have Schedule 1. And the income that's on the face of the return is supported through other schedules. Like this Schedule 1, where it has additional income and adjustments. When we look, this is important to look at because on line 3, it says business income attached Schedule C. So I know that there's a Schedule C filer on this return, which we're going to go through. And they had net income of $27,000. And then on line 5, you can see they had a loss of $224,000 that flowed through Schedule E, which is rents, royalties, and other pass-through entities, S corporations, etc., which Lou's going to cover in a little bit. And then we have also, this is where gambling winnings gets reported. They had gambling winnings of $22,000. So if you scroll down to the bottom of Schedule 1, you'll see that the additional income was a negative $175,000. And if you scroll back up to page 1, you'll see that $175,000 on line 8. So when you look at line 8, if there's an amount there, you'll go to Schedule 1, you'll see what the makeup is. And if it refers to other schedules, like a Schedule C or Schedule E, you can backtrack to see what that is. And I believe, Lou, you're up.
All right. So let's talk about Schedule A. So when a couple is getting divorced, a common question is during the pendency of the case, who is taking the itemized deductions. So the first thing that's very important to understand is there's something called the uniformity rule. Okay. So if let's say the date of commencement is in 2023, and now we're in 2024, and the parties elect to file separate tax returns, married filing separate, how do you handle itemized deductions? Well, first and foremost, you have to remember that if they're going to take the standard deduction, both spouses have to use the standard deduction. If one spouse is going to itemize deductions, both spouses have to itemize deductions. Okay. That is what is known as the uniformity rule. As far as who can claim each of the deductions, it really comes down to who's paying it, right? So mortgage interest, it's typically jointly paid, and you're allowed to split that mortgage interest 50-50, if you want to. But sometimes you have, spouse A has higher income than spouse B. So from a tax perspective, it's more advantageous to load the itemized deductions onto spouse A's tax return. So there definitely could be some tax planning that gets factored into how those are split. But it's just very important that the method which the parties are using, whether it's itemizing or using a standard deduction, is uniform across both tax returns. Now we use Schedule A, the itemized deductions, a lot of times in checking the expenses that are reported on the parties' net worth statements if you're in New York, financial affidavits if you're joining us from Connecticut. And here's just a couple of examples of that. So right at the top, the first itemized deduction that a taxpayer is allowed to take are medical expenses. Now, keep in mind, Rich mentioned this earlier, that medical expenses are limited to 7.5% of your AGI floor. So what does that mean? If you have $100,000 of adjusted gross income, 7.5% of that is 7,500 bucks. That means the first 7,500 bucks of medical expenses are not deductible and wiped right off the board. So why am I telling you that? Well, if you're looking at the itemized deductions for medical expenses and you look over here on the right, you might not be capturing all of the medical expenses. And if you're comparing it to the net worth statement, you're not going to be able to compare apples to apples. What you want to look at is box one right here, which has all of the unreimbursed medical expenses. So you would compare this box here over with the unreimbursed medical expenses that are reported on the statement of net worth. Now, moving along to uh, the taxes that you are allowed to deduct as an itemized deduction. So this has been certainly a hot topic in the last few years with the SALT taxes, and no one's happy that the SALT taxes were limited to $10,000. Now, what are SALT taxes? State and local taxes. So that's going to be state and local income taxes, and that also includes real estate taxes on a primary residence, as well as a second residence that you're allowed to do. Now, for the last few years, since the Tax Cuts and Jobs Act, TCJA, was enacted back in 2017, like I mentioned, you were capped at 10,000 bucks. So once again, if you're looking strictly over at the right side here, you're going to say, well, real estate taxes must have been $10,000. But that's not really true. You have to look at sort of the detail here and see the state and local personal property taxes. In this case, with 4,000 bucks, I'm sorry, the real estate taxes with $35,000. Now, again, if you're going over to your net worth statement or your financial affidavit and you're trying to, make sure it's filled out to completeness, you don't want to use your $10,000 here. You want to use $35,000. Now, we all know last year the OBBBA, the was enacted and put into force, and that actually increased this $10,000 limit to $40,000 now. That $40,000 will be increased by 1% every year for inflation measures, and that'll last until 2029. In 2030, it's supposed to revert back to the $10,000, but we will see if that actually happens or if there's some other law that gets enacted. Interest paid on a mortgage. Again, you're allowed to deduct interest paid on your primary residence as well as secondary residence. So that would be the mortgage interest that's deducted here. And then also gifts to charity. Once again, net worth statement, financial affidavit. If there's in that miscellaneous section, that's usually at the end of the expense sections where we talk about gifts to charity, we can certainly double check it against the tax return here. This is subject to certain limitations. So you definitely want to, again, don't just rely on the numbers over on the right side of Schedule A. Do look at the detail that is within. And a lot of times we like to look at gifts to charity, when we have those cases where we have a certain level of lifestyle of the parties, but we are, claiming not a lot of income by the parties. We like to look at how charitable they're being with a reduced level of income. Once again, it's just sort of building a case, building an argument. Charitable donations is usually a good place to show the wherewithal and the ability to pay that. And I'll skip down. This is sort of a new thing. Well, it's an old thing, but it's changing. Gambling losses, you can only offset gambling income here. So if in the past, up until 2025, if you had $100,000 of gambling income and you had $120,000 of gambling losses, you can only deduct 100,000 of the losses here because you couldn't take more loss than you had income. Interestingly, now going forward, your losses are going to be limited to 90% of your income. So if you have $100,000 of gambling income and you have $100,000 of gambling losses, those losses are actually going to be limited to 90% of the income or $90,000. So even though you broke even for the year, you're going to be reporting $10,000 of income. Just a sort of fun anecdotal fact there. So moving along, we have Schedule B. So Schedule B is for reporting. There's actually three things. I want to focus on two to start, which is interest and ordinary dividends. So as you can see, this is a reference right here under the interest section, part one. See Statement 10. So what does that mean? Well, at the back of the tax return are what are called federal statements. So what happens is the tax return allots for a certain amount of lines. So you can see it's probably about 15 or so lines that the standard form tax return 1040 gives you for reporting interest income. But this particular taxpayer must have gone beyond those 15 lines. So what the tax return does is it puts a statement over in the back. So what I'm going to do is shoot on over to Statement 10 to show you what that looks like. So now here is all of the detail to that interest income that we just saw on Schedule B. And what this is reporting is from a Schwab account, 1, 2, 3 UBS accounts, a fourth UBS account. It looks like there's 2 Schwab accounts. What we're looking at here are different bank accounts that are and brokerage accounts that are reporting interest income. This is a good way for us to check against the net worth statement and the financial affidavit to verify that all of the accounts, all bank accounts, all brokerage accounts are being reported on that financial affidavit. Not only do you have bank and brokerage accounts that are being reported for interest income, but you also have, you see down here, I'll zoom in, it says from K1. Now we redacted it, as you can see, to protect the innocent and for confidentiality purposes. But what we actually have behind these redactions are entity names. So what that means is these entities have some mechanism by which it's receiving interest income. Maybe there's a brokerage account that's being held on the entity, right? And that interest income is going to pass through the entity to the taxpayer. And that gets reported on Schedule B as interest income. And this is what it looks like from K1. And then there would be a Schedule K1 that matches these exact figures that are over here on the right side. Let me take a step back now. So now we're back to our Schedule B. I just showed you, let me go back to the back here. The total of Statement 10, 14,901. If we go back to our Schedule B, as you can see over on the right, 14,901. It's a match. We're all good. Now you kind of see mechanically how the statements work in the back of the tax return. Let's move ahead to Part 2, which is ordinary dividends. Very similar to interest income. If there's a brokerage account that has investments that are spinning off dividend income, that dividend income is going to be reported by the taxpayer on Part 2 of Schedule B, to zoom out so that you see it. Again, it's reported by way of listing out the financial institutions and the account numbers for which that dividend income was received. And then further down, if there's a mechanism by which a business interest is spinning off dividend income and it's passed through to the taxpayer, it's reported on Schedule K1, which is then reported on Schedule B, and it looks exactly like this from K1. Okay. Now there is a third part to Schedule B for foreign accounts and trust. Now there's no numbers here, as you can see in Part 3, and I'll try to bracket this right here. So what exactly is Part 3 of Schedule B showing us? Have you ever had a client that comes to you and says, "Hey, I think my spouse has foreign bank accounts and they're hiding assets overseas"? Well, there is the Financial Crimes Enforcement Network, uh, commonly known as FinCEN. FinCEN has Form 114, which is commonly known as FBAR, and you can kind of see that right here in the middle. Okay. FBAR or Form 114 is for the purposes of reporting foreign bank accounts and foreign trusts. Now, why do we like this disclosure so much? The threshold for reporting an FBAR Form 114 is only $10,000 in US dollar equivalents. So as you can see, this taxpayer, they checked off no, so they didn't have to file a Form 114. But let's say this was checked off as a yes. FinCEN is not the IRS, okay? It's a different department under the Treasury, okay? Under the Treasury Department of the government, which means that there's no requirement to attach Form 114 to a personal tax return. They're entirely different filings. However, if this box is checked off as yes, your next discovery man should absolutely include FinCEN Form 114 and make sure that you get that to understand what foreign bank accounts are out there. Now, in addition to Form 114, the IRS actually does have its own form of foreign asset disclosure, and that is going to be in Form 8938, which I'm going to shoot over to here. So Form 8938 actually is a IRS form. So to the extent that there are foreign assets that qualify for Form 8938, the taxpayer would have to fill this out. Now I mentioned that the threshold for Form 114 was 10,000 bucks. The threshold for Form 8938 is if the foreign assets had a value of $100,000 at any point during the tax year, or if it was $150,000 to end the year. And conversely, if it's and that's for married filing jointly. If it's a single taxpayer, it's $75,000 at any point or $50,000 to end the tax year. Okay, so those are the thresholds for filing 8938. Now, Form 114 is strictly for bank accounts and trusts. Form 8938 actually also extends to not just foreign deposit and custodial accounts, which are bank accounts, but also if you go to Part 4, they call it other foreign assets. So that actually includes real estate, business interests, things of that nature. in addition to bank accounts. So this is just a good sort of starting point to get an idea of what
Mhm.
foreign assets are out there. You have to report the country that it's reported in, or that the asset exists in. You have to report the value of that asset. So there's a lot of good information to be ascertained out of Form 8938.
Hey
And
Lou,
now, oh yeah,
we
yes,
have a
Steve.
couple. We have a couple of questions, and one goes back about 10 minutes in the presentation. So I apologize for not bringing it to your attention earlier, but we've got about four questions before you move on. First one is if a party takes split deductions, can that ever result in not benefiting from the itemized deductions?
So you would only take itemized deductions if it's going to exceed the standard deductions. So
Mhm.
the standard deductions in 2025 were 31,500 if you're married joint, and 15,750 if you are a single taxpayer or if you're married filing separately. So what you would really do is you would look at all of the itemized deductions. If they're going to exceed $31,500, you would take that, right? You would take your itemized deductions, you would figure out how to allocate it amongst the parties. If your itemized deductions only amounted to $28,000, say, um, then you could conceivably file each doing a standard deduction of 15,750 unless it benefited to itemize the deductions and have the one spouse take all 28,000, which is more than the 15,750 on the single standard deduction, and the other spouse take zero because maybe they don't have any income and maybe there's nothing to offset. So that would be the rare instances that you can opt to itemize if even if you're not reaching the total standard deduction of 31,500 combined between the two.
Thanks, Lou.
Yeah, and in addition to that, if you're married filing jointly, the tax rate's a little different than married filing separately. If they're going to split income and try and split deductions, et cetera. So you'd have to play with the scenario.
Yep.
Thank you. So next question is, if you have a jointly owned account that's non-marital, how is the interest reported? Separately on two returns using the 1099-INT?
Can you repeat that
Yeah,
question?
Yeah, if you have a jointly owned account and it says non-marital, how is the interest reported? I guess how's the interest generated from that
oh,
account
yeah,
reported?
okay.
Separately on two returns using the 1099 INT?
Well, why would a jointly owned account be non-marital? I don't understand that question. So, Rich, if you understand it, you can answer
Yeah,
it.
well, I get. Let's take a scenario. If there's two non-married people living together, they open up a joint account. They both have signatory rights on that account, and if it's earning income, one of the taxpayers are going to have to put it on their return.
Got it. So
And,
maybe
and in reality, what could occur? Let's say they maybe, let's say they don't report it. Let's say they do not report the income. The IRS will charge both of them until one of them pays. So
all
that's like a
right.
reverse answer, I guess. But someone will be held on the hook, for the tax on the earnings on that account.
Okay, thanks. The question asker actually just elaborated a little bit, and I think the question was like a jointly owned account by two parties. It doesn't really matter if it's a matrimonial situation or not, like if it's two brothers or if it's a mom or a son.
They
And
could split the interest income 50-50 if they elect to do so.
And
got
note it on the return. You can note it actually on the return that they did that.
a couple more. Why are W-2s appended to the tax return but not K-1s?
Well, that's an interesting question because actually W-2s are not always appended to the tax return. There's no requirement to actually attach the form W-2 to the 1040. There are sometimes you'll see at the back of the tax return, and I don't think this is an example of one. Let me just double check. Oh, here you go. So sometimes you will get a federal statement in the back of the tax return that does contain W-2 information, but the W-2 itself doesn't have to be attached to the tax return.
But so Lou, just do me a favor. Just scroll to page one of the tax return because I think that's where they may be getting it from. Look, see where it says income, attached forms W-2. Also, I don't know why that's there because
Didn't know.
I would guess a minimum, and I could be low on this. 75% of taxpayers file their tax returns electronically. And when they file their return electronically, W-2s are not attached. And like Lou just pointed out, they have it in a statement on the back of the return. So if you're mailing in a tax return and someone sees that, they may staple their W-2 to it. But I do not think, I know it's on there, but I don't think it's a requirement. I don't think the IRS will come back and haunt you if you do not attach your W-2 on a mail-in tax return, because most of the returns are electronically filed and the W-2s are not filed along with them. And to answer the question on the K-1, the IRS has an incredible system of information where they can just put everything together on someone's return. You know, they have a very sophisticated system of matching documentation up.
Thank you. That was a very comprehensive answer, guys. One more, actually, there's two more. Where should one look for any trust income?
Trust,
Depending
we
on,
haven't gotten there yet.
yeah, and we'll get there in a minute, but it's depends on the nature of the income.
Spoiler alert. We'll get there in
Yes.
a minute. Okay, and then the
Yeah,
last
so
one before we can move on. This actually relates to Form 8938 and FinCEN. Is a necessary requirement of Form 8938 or FinCEN? Is it noted anywhere on an IRS tax transcript?
That I'm not sure about.
Okay, we
okay,
will circle back to that question.
yeah, so we're gonna have to move a
Find the
little bit
answer.
because it's getting a little late in the webinar. We're like 12 minutes left, so I'm going to go through these sort of a little quickly, so we can get to everything. But this is Form Schedule C, which is filed by a sole proprietor, an entrepreneur, or a single member LLC. So when we looked at that Schedule 1, you'll see it said it had income from a Schedule C. So when I see that, when you see that, you can jump to the Schedule C and should this business be valued? You know, this is a business and should it be valued? So you see the on line on line C, it says, I guess, I guess line A, principal of business. We're a little conservative, and I guess we took that out. But if you wanted to see what type of business it was, it would be on that line item. And then in box B, they put the business code, which we utilize for our own purposes for market data, ratio analysis, etc. But if you go down to line one, part one, line one, income, the income was $46,000. You could talk amongst the parties. Is this a business that should be valued? We see Schedule Cs that could have $500,000, and that would be a marital asset that you would want valued. And so it's and on a Schedule C, you have your income, you have your business expenses, and then on line 29, you'll see 27,555, which is the net profit, which flows through to Schedule 1, which then flows through to page 1 of the tax return. But if you see a Schedule C, you need to consider if this business entity should be valued or not. And there's more I could have said on that, but you know, we need to, for the essence of time. So now this is Schedule D. Very important form to look at. This is your capital gains and losses, sales of stock, and it's broken into two sections, Part 1 and Part 2. Part 1 is assets that are held less than a year. They're taxed at regular rates. If it's long term, it's taxed at long term rates. So the important thing to note here is that these at one time were assets, and they still could be accounts that have assets in them, which you, as Lou pointed out earlier, you could cross-reference to the statement of net worth to see if they list these accounts, should they have anything left in them. So on this return, you'll see the total on line 7, the net short-term gains from their selling of stocks, etc., was $7,000. That gets combined with the long-term capital gains on line 15, as it's held more than 1 year, of 1,900. So if you go to the next line, the next page, Lou, you'll see that they had $8,900 of capital gains. Now, it's very easy that this line could have been $200,000 of capital losses. And losses, if it's $200,000, the IRS allows you to deduct $3,000 in that year, which means that $197,000 can get carried forward to be offset against future capital gains. And again, in a year of a divorce, if they have $197,000 of loss carry forward, that's something that you should be discussing with your clients as what should the equitable distribution be, if anything, in that, and how that plays into it. Because that's a loss carry forward that has a very good tax benefit going forward. And Lou, I mean, that was a quick thing on the Schedule C and D, and Lou needs to jump into now Schedule E.
Yeah, and I'll just quickly show you. As you see on Schedule D, there's references to Form 8949 here. Schedule D shows you summary numbers. It's, the entirety of the short-term losses or gains, the entirety of the long-term gains or losses. The detail to this information is contained in Form 8949. And again, Form 8949, it gives you the description of the property. Sometimes
Mm-hmm.
it's reported as the account itself, so it's helpful in determining if there's any hidden, brokerage accounts, things of that nature. It could also be reported as the shares themselves. So instead of UBS here, it'll say shares of Apple or shares of Amazon.
Mm-hmm.
But what's also really just important to note on Form 8949 is in 2014, the IRS began considering digital assets, quote unquote, property. So just as you could sell your Apple stock, your Amazon stock, you could sell a piece of real estate, and they're all considered real property for purposes of tax reporting, and therefore you have to report the gain or loss on the sale of those items. Same thing with digital assets, cryptocurrency, NFTs. The IRS wanted to make sure in 2014 to tag that property nomenclature to it. So if there's any sales of any cryptocurrency or digital assets, it will also appear right here on Form 8949. So I'm just going to skip ahead and we'll quickly go through Schedule E and let you guys go on your merry way. So Schedule E is broken up into two parts. Part one of Schedule E is for rental real estate and for royalties. So what this box here shows you, so every line is going to be a different asset. So here we have one asset. So that's why we only have A. Now, if we scroll down a little bit, A, it's giving us this property code of 6. And if you go down to the legend just below, now we know that this is royalty income based on code 6. And if we go a little bit further down, the income that's reported is also for box 6. If the taxpayer owns real estate, not their primary residence, but any rental real estate, that
Mm-hmm.
real estate and the income and the expenses associated with that real estate gets reported on part one right here of Schedule E. So this is a nice little place to go to if you want to see what sort of real property and real estate is owned by the taxpayer. Um, we always talk about income versus cash flow. I just want to point out this little expense item down here called depreciation expense and depletion. So a lot of
Mm-hmm.
times you'll have rental income, you'll have all the expenses that offset it, and then you'll have a massive number for depreciation expense that wipes out almost the entirety of the income. Depreciation expense is a non-cash item. So when you're looking at this particular schedule for the income that's generated by a piece of property, be sure to consider the depreciation expense as an add back to that income
Mhm.
and as a non-cash item. The second portion of Schedule E, Part 2. So this is income, this pass-through income or losses from partnerships and S corporations. So we talked about the federal statements before. This is directing us to Statement 18. So I'm going to go on to the back of the tax return here and show you Statement 18. So what this is showing us is every single pass-through business interest that is owned by whoever this tax return is reporting for, whether it's one spouse, two spouses, one taxpayer, two taxpayers. It's showing the business interests that are being reported by that person. It reports passive losses, passive income. It also reports non-passive losses and non-passive income. I point that out specifically for all of our friends in New York, where whether or not a business interest is passive or non-passive might factor into the valuation date. The manner in which the income or loss is reported on Schedule E here is sort of a good insight as to whether or not it's passive business activities or active business activities, if you will. And each different line item is going to be a different business. So as you can tell, this particular taxpayer had many, many business interests, investments, things of that nature. And all of the totals, as you can see, the totals go to Schedule E, line 29. If we go back to our Schedule E, which is right here, all of those totals aggregate
Mhm.
to what you see here on Schedule E. So we are just about running out of time. Rich and I did prepare within the slides here. Let me just go over to that. We did provide sort of a little bit of a roadmap, key
Mhm.
indicators for income, key indicators for assets and liabilities, for financial lifestyle, and it's just the different parts of the tax returns that we go to in order to, kind of vet out these various concepts, income and assets and lifestyle. So, we'll circulate this material, and these indicators will all be in here for your
Viewing
liking and your
pleasure.
review, for your viewing pleasure. And that could be a good roadmap for you as you're trying to reconcile income and reconcile assets and reconcile lifestyle, things of that nature
Right.
going
Mhm.
through the tax return. So with that said,
But Lou, we will be staying on for a couple of minutes in case people
yeah,
do have some questions at the end, right? So we're not gonna leave everyone hanging if you have questions.
that's where we are now.
Sounds great. So let's get to the first one. If depreciation is a non-cash item for purposes of determining AGI and spousal support calculations, do you add back the income?
If we're retained to determine cash flow, we would add that back for cash flow purposes.
Then there's a follow-up question. What about the tax due upon sale for taking depreciation? So I guess if you write down an asset depreciation expense, and then you later sell the asset, how is that?
Yeah, so there's definitely depreciation recapture, but that
Hmm.
also depends on whether or not you're actually factoring in a bona fide sale of that property. So, we don't always factor in the taxes if we're looking at, a hypothetical sale, if you will.
But if you're selling the property and depreciation was taken on it, it's a lower basis that you have,
And it
when
will
you
affect the
sell it.
tax liability.
So,
Yeah.
so if you bought a property for $500,000 and you depreciate it by 250,000, your basis is 250. If you sell it for 500, you didn't break even. You have a gain of 250, or it's a taxable event occurs.
Yep.
Great. Thanks, guys. That's it as far as the questions go. Just want to say, just before we leave, I'd just like to encourage everyone to check out the catalog of past webinars on YouTube, which I told you about at the beginning of this webinar. We'll be sending out an email following the conclusion of this webinar with a link to view the recording on YouTube, along with the slides and example pages from the tax returns, so that, as Rich said, you can, view them at your leisure. So we want you to have a great weekend, and if you're in the Northeast, enjoy the lovely weather that we're having right now. We'll see you in May for our next webinar, and we'll share details of this webinar when they are finalized. Thanks, everyone.
Okay, thank you.